market made a pretty good comeback following the drastic dip in early 2020. And just when it felt like we were free and clear, in the first 4 months of 2022, the stock worldwide has returned an average of negative 12.8%. So what gives? Should we be worried? Is there something we should be doing with our money given this dip? In today's video, I want to address some of these trends and concerns. Hi, if you're new to the channel, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. This video is broken into 3 parts, so feel free to skip around to the sections you would find most useful. First, I want to share with you some factors that are contributing to the current stock market. What might be causing the stock market to behave the way it is. Second, we'll take a step back and try to understand what it all means, especially when we put it in a historical perspective and see if we really need to be worried. And third, most importantly, we'll talk specifically about what we should be doing with our own money to navigate these uncertain times. First of all, the most pressing piece. Why is the stock market down? Let's review 3 of the most talked about converging factors. The first factor that people have been talking about for a while is the high inflation and rising cost of goods. According to the US Labor Department, as of April 2022, the annual inflation rate for the United States is 8.3%. Where I live, this is most notable with the crazy high gasoline prices. In some places, we're needing to pay above $6 a gallon for gasoline. With prices at record high, Americans are feeling the impact in grocery stores and at the gas stations, both as consumers and as businesses. Consumers are buying less because there's just less money to spend. And businesses are tightening their belt because the cost of doing business is just more expensive. Second factor tied to the first is the increasing interest rate by the Federal Reserve. When inflation is too high, a tool that the Federal Reserve uses to combat rising prices is by setting higher interest rates. Higher interest rates makes borrowing more expensive and thus has the effect of slowing the economy down, and thus, in theory, inflation. And the Federal Reserve Chair Jerome Powell has said that he will continue to back the interest rate increase until prices start falling back towards a healthy level. The hope is that the Federal Reserve can raise rates at a moderate level to combat inflation without plunging the whole economy into a full-blown recession. But the jury is still out on if this will be possible. The third factor is just a combination of multiple significant worldwide events that is fueling the overall uncertainty around the market. With the world being so intertwined, nothing happens anymore in a vacuum. One event on one side of the world is felt at the other end. Russia continues its invasion of Ukraine, impacting worldwide supply chains and sending energy prices through the roof. China continues its extreme lockdown of some of its biggest cities as COVID cases remain high and thus has slowed down China's economy. An overall labor shortage has sent salaries soaring and continues to hinder the flow of goods around the world. And when we combine all these factors, we get the most common trait to market dips and crashes: fear. Fear feeds more fear, and when people start to see the stock market dip, it becomes a domino effect. The market so far has lost nearly a fifth of its value compared to its peak in January 2022. When people see their investments lose value, it makes people pause and get worried. Probably the reason why you clicked on this video. You see your investments dipping and you're thinking, what should you do? And when there is fear in the market, people sell their stocks. And this leads to more decline and then more sell-off. It's a vicious downward spiral. So the next question is, what does it all mean? Should we be worried? Is this going to get worse or will the market turn around? Many economists and Wall Street professionals are saying that recession is pretty likely. It's hard to stop the rising inflation without a recession. But the Federal Reserve is saying that we're aiming for a soft landing. So what will it be? To be honest, no one really knows. And anyone proclaiming that they know exactly what will happen in the next few months is really full of air. But the fact is that a lot has happened in the last few years and a lot is happening right now. And if we were to take all the news at face value, we could easily conclude that the world is coming to an end and we should all sell our assets and live in an underground bunker. However, it's important to take several steps back and get some perspective on the current market status. The fact is that market dips and crashes aren't new. Actually, they're quite familiar and happen quite regularly. Yes, are there specific events and factors that cause each market to crash different? Of course. As Morgan Housel, the author of Psychology of Money, stated in his book, the correct lessons to learn from surprises is that the world is surprising. There's no way that anyone could have guessed that COVID-19 would have hit us like it did, that Russia was going to invade Ukraine in 2022, and China would just go and lock down one of its biggest cities overnight. However, just like surprises aren't new, market crashes aren't new and should actually be expected. When we just keep winding the clock back, we're hit with so many so-called surprises after surprises that in essence crash the market. The housing crisis of 2008, the 9/11 terrorist attack in 2001, the tech crash of the late 1990s, the Black Monday of 1987, the massive inflation of the late 1970s and early 1980s. We think 5% mortgage rate is high? Try 20%. We could keep going, but you see the trend here. The specific trigger is impossible to predict, but what is consistent throughout history is that dips and crashes in the market are to be expected. The news makes it sound like the Federal Reserve increasing its rate is shocking news. But it is not. They've done it many times in the past, and they'll continue to do it in the future as the tool to manage the economy. The war in Ukraine is tragic, but conflicts are not new. Supply chain problems have always existed. It's just more exacerbated due to certain specific triggers. For some reason, we are all surprised when these type of events happen, but if we're students of history, it really shouldn't be. The mass media has conditioned us to make us think that these are significant events that we should be surprised by. But they're incentivized to sell news, so we can blame them. And to be transparent, I'm doing the same thing with you in this video. And this is a good time to point out that you should really be careful when you're getting your financial information from YouTube or social media, including myself. A lot that I share in this video are personal opinions, and at the end of the day, you need to personally validate all the information you hear. Information is good, but don't just blindly follow them just because some random guy on YouTube is telling you what to do with your money. Alright, so with that, let me tell you what you should do with your money. What should we do with our money during these uncertain times? Let me share with you 3 personal recommendations. And I want to note that these recommendations are fundamentally not that much different from what we do with our own money if the market was going up, sideways, or down. The first recommendation is to continue to stay invested in stocks, especially in low-cost index funds like the Vanguard Total Stock Market Index Fund. This chart shows the Dow Jones Industrial Average in the last 100 years. What you notice here is that there are dips in the market everywhere, but the market is also continuously surging forward and up. And this is because the market is made up of thousands of publicly traded companies that are working hard to continuously create value for its customers. Even in these uncertain times, companies that represent the market are trading new products, expanding their businesses, and generating healthy profits for its investors. Companies that can't go bankrupt, and new and upcoming companies take their place. And thus, when you're owning a low-cost, broad market index fund like Vanguard Total Stock Market Index Fund, you're able to go along for the ride up. And history has shown that despite the dips and crashes in the market will recover. 50 years ago, in 1972, the S&P index was around $100. In 2022, the average closing price is around $4,000. Give and take a little given all the volatility. And the ride has had tons of ups and downs throughout. But at the end of the day, the annualized rate of return resulted in 11.7%. This means that if you had invested $1,000 in 1972 and just left it in there, it would have grown to $164,000 today. But this requires patience and fortitude to have left that $1,000 invested throughout this whole period. Not trying to time the market, or selling because you're afraid that the market will never recover. It is during these times when the market seems like it's on the verge of collapsing where true wealth is made. So do you stay in or do you panic and sell? I'll tell you what you definitely shouldn't be doing. Don't sell your stocks because you're afraid of losing your money. Don't sell one investment to buy another in reaction to the market. The market is a complex being, and trying to beat it is a fool's errand. And whatever you do, don't constantly look at your investments. Your mind will constantly think about where you give your attention to, and there's a higher chance you'll do something rash if you keep looking at your investments fall. My recommendation is to do nothing if you're already invested in the market. If you have some extra money, then invest it. But most importantly, let the investment ride the roller coaster and meet it at the other end when it comes out more than it began with. Second recommendation is to hold cash. Wait, you might be thinking, didn't you just tell me to invest in the market? Shouldn't I take all my cash and put it into the market to work for me? Yes. You definitely don't want to sell. You want to stay invested in the market. But you also want to be wary of expending all your cash in pursuit of more investments. We don't know what the future holds. The news is full of predictions of the future, but at the end of the day, no one really knows. And the best weapon against uncertainty is a strong pile of cash. If you have gone bowling as a child, you might remember using what is called bumpers or guardrails. These bumpers would essentially keep your bowling ball from falling into the gutter. They kept you in the game even though you might have launched the ball improperly or your ball started spinning in the wrong direction. Think of a strong pile of cash like these bowling bumpers. If the market continues to dip and we enter a recession, it could have a ripple effect on our personal lives. Our income could be impacted. Things might start to cost more. And if we need cash, it would be a tragedy to have to sell our investments at a loss if the market hasn't recovered by then. We don't know what the future holds, but having enough cash will ensure that we don't get derailed and help us stay committed to our life goals and investment strategy. The base recommendation is 3 to 6 months of expenses in a liquid account. But given the current uncertainty, I would go as far as recommending even 12 months of cash. Don't look at holding cash as losing out on investment growth. Look at it as your personal bodyguard that will protect you during these uncertain times. The third recommendation is to ignore the market noise. During these times of market uncertainties, pretty much all that the news outlets are talking about is the market and the economy. And the reason is because it attracts readers and viewers. People get concerned when they see their investment portfolios drop in value and are clawing for information to see what they should do. Probably the reason why you clicked on this video. But take the information you gain from most of these news outlets with a grain of salt. The headlines are always sensational and alarming, even when the reality may be not so crazy. As I mentioned earlier, market dips and crashes aren't new. They're actually part of the cyclical process of the market. But when we glue ourselves to reading every article about the market and watching every news channel about the upcoming crash, we can't help ourselves but get swept up by them. We become what we focus our minds on. And that is why even though deep within our hearts, we believe that the market dips are normal and to be expected, when we constantly hear news about how crazy the market is, we can't help ourselves but be affected by it. And God willing, we panic and consider selling. My advice is to digest some news for informational purposes, but don't allow yourself to get sucked into a never-ending hole of sensational media. It'll save you a lot of brain space and give you a peace of mind that you aren't being manipulated for someone else's benefit. A lot of things could happen in the upcoming weeks and months. The Federal Reserve could continue to increase its rate with hopes of curbing inflation. The war in Ukraine can drag out for many more months. The lockdown in China can get worse. But who really knows, right? To think that any one of us can predict the market, I believe is quite arrogant. Yes, the market can decline even more, and we can enter a period of real recession soon. But the next 10 years and 20 years will also have many more collapses and recessions. But market dips are part of the process. In the next 10, 20, 30 years, we'll have more collapses and more recessions. We need to embrace them and have faith that the market will eventually recover. And when it does, your net worth will grow. At the end of the day, ignore the noise and stay the course. Thank you guys for watching. If you'd like to learn more about some great low-cost index funds to add to your portfolio, check out a few of my videos here. Until next time, all the best.